Hey, what's going on, guys? Want to make a video in terms of how to short stocks, right? Generally we talk about going long or buying a stock, which is making money when the stock is actually rising up in price. However, there's also opportunities when the stock doesn't really go up, it actually goes down, and that's where it's called shorting of stocks. So in terms of what shorting a stock is also known as so-called short selling. It involves the sale of a stock that the seller does not own or shares the seller has to take on loan from a broker. So let's say, for example, if you want to see you see GoPro stock and you want to go and short it. To short it, if you don't have it, you can go and sell it, right? Or you can borrow it from a broker and then sell it. The idea really is you sell it taking as a loan from the broker, and if the stock were to actually go down in value, you buy it back at market and give it back to the broker. So first, you always have to understand the motivation to sell short, right? Short sellers take on these transactions because they believe a stock's price is headed downward, and that if they sell the stock today, they will be able to buy it back at a lower price, right? That's the intention, for the stock price to actually go down in value. And if they were to accomplish this, they will make a profit consisting of the difference between the sell and the buy price. So if you think the price of, say, GoPro is at $100 and it's too expensive, it's supposed to go down to, say, $10, then you go and short it, right? So some traders do short purely on speculation, while others want to hedge it to protect their downside risk if they have a long position, right? So let's say you have a whole bunch of stock portfolio where you have a whole bunch of names. If you want to hedge your risk, the only way you can do it is by shorting maybe spiders, SPY, right? Intention of, if your whole portfolio is long, if it goes down in value, you have the hedge to, if those go down in value, but because you have SPY short, then you will be able to make some money on it to hedge out your risk. Now, let's say in terms of shorting an ABC shares, right? So suppose you believe that the stock of ABC is really overvalued, and you really think that, you know what, this stock is actually going to go crash down sometime soon. You believe this so strongly that you decide to go and borrow 10 shares of ABC stock from a broker. So as I mentioned, when you short a stock, you don't have to own it. You can just go and borrow it from your broker. And you sell the shares with the hope that, hey, you know what, this stock can actually go down in value. So you go and buy 10 shares at $50 each, right? So when you go and sell 10 shares at $500, you get $500 in cash. Because when you sell, you get money. When you buy, you have to give money. So this is what is supposed to happen. However, in reality, you would pay a small commission, and depending upon the timing, you might also pay dividends to buy our shares. Keep in mind, when you talk about stock investing, there's a buyer and a seller. So if you are taking the seller position, then if there's a buyer, if the buyer bought a stock, because you're going to get dividends. You're the seller, so you'll actually end up paying dividends because you are the seller. But these are omitted in the example simplicity. So now you have $500 in cash and have an obligation to pay these stocks. If the stock goes up above the $50 price, you will lose in value. Right? You will lose money because you will have to pay a higher price to buy it back. So let's say you short at $50. You know what? Shit goes upside down and the stock actually goes up to $250, right? So now you'll have to go and spend $2,500 to buy back 10 shares that you owe, right? So you still own the $500 when you sold the shares, but now you have to come up with $2,500 to buy it back. So your net loss being $2,000, right? The best case scenario is the stock really goes bankrupt and you make a whole bunch of money. Let's look at a real life example. So let's say if you are looking at something like, say, let's go to stockcharts.com. So let's say you go and look at GoPro, right? Pretty heavily shorted name. Let's try to pull that up. Chart. So you look at GoPro. It did go and it started at about $25, ran up to $100, and people are like, shit, this is nothing but a camera on a stick. So you can start shorting the stock, right? If you start shorting over here, you'll get smoked out because this really went up, right? In this situation, if you bet somewhere down here, this is where shorting of the stock makes the money, right? So you are betting on the stock to go down in value. When you go long or buy, you're expecting the price to go up. But when it goes down, this is what you're expecting when you go and take a short position. So that's one of the examples. So in terms of risk, you have to be involved that, you know what, there could be a potential of unlimited risk because the stock can go up unlimited. Right? So when you short a stock, you expose yourself to potentially large financial risk. In some cases, when investors and traders see that a stock has larger short interest, means a lot of people are a big percentage of the shares are being shorted by speculators, they will actually drive the stock high. If you see a lot of short names, chances are they can have a pretty fierce uh, stock covering rally, right? The way you can find in terms of the short is if you go to a site called finviz.com, if you go to screener, right? Um, Fundamental, technical. Um, so let's say if you say float short, right? What are the stocks which have extremely high float short? So these are the names that you will see, right? You're seeing this AOI, ABO, AEMX, and all these other fun stuff. If you look at these ones, these stocks can be really, really wild, right? You see these big ranges on these stocks. There's a reason why, right? You see all these gappers, really, really ferocious stocks, which is really hard to handle, right? So that's if the stock is really a lot of short positions, chances are when it starts running, it can really run pretty hard, right? Candle, weekly, right? So if you start seeing, once the stock gets decimated, you see decimation, but when it starts running, I mean, you can run quick, right? For it to really decline from $100 to $20 took a while, right? But when it went from to double, it kind of doubled in less than 5 months. So that's pretty ferocious, right? $120, loss of value, quite a bit of about $80 on that downside, but it kind of 100%, it made this 100% move in less than 5 years, right? Once again, in terms of if you want to see how ferocious these are, once again, I mean, once this short covering starts, it goes up from $15 to uh, $10 to over $20. So pretty ferocious. So yeah, I mean, that's how the short selling happens. And if you have any questions, hit me up. If you like the video, please like and subscribe. Have a good one.